On today's episode of Ask a Lender, I'll be sitting down with Shelbie White from Fairway Mortgage, and we'll be discussing private mortgage insurance, better known as PMI. She'll be answering all your burning questions like, is it required, when PMI is a good thing, and how to get rid of it now. Hey y'all, Abby Husbands here. I'm a realtor in Austin, Texas. And if this is your first time stopping by, you might want to consider subscribing to my channel where I talk about all things real estate related, and I pepper in a few videos about Austin, Texas, and my favorite things to do in the city. So today is our series called Ask a Lender, where I sit down with my friend and lender, Shelbie White with Fairway Mortgage. And today we're going to be discussing private mortgage insurance, which is better known as PMI. Okay, so today I'm talking with Shelbie White with Fairway Mortgage. Hi, Shelbie.
Hello.
And we're going to be talking about PMI, which is private mortgage insurance. So explain to everybody exactly what is private mortgage insurance and when do you need it?
So private mortgage insurance is insurance for the lender in case of default. What that means is that a portion of your loan is insured in case of default. If you were to stop making your payments, the lender would get reimbursed for a percentage of that loan, depending on varying circumstances, how much. But so it's basically protection for them. And it's what makes them willing to loan with less than 20% down.
Okay, perfect. So the PMI is based on, like, say someone is going to put down 10%. What is the PMI based on?
It's based on the initial loan balance. So if you have a $100,000 sales price and you're putting 10% down, you're borrowing $90,000.
Okay.
So you're putting $10,000 down, and that's your 10%, and then the remaining balance is $90,000. That's going to be your loan balance. So the PMI is based on that loan balance and that initial, what lenders call loan to value.
Is this like a third party insurance, like say homeowners insurance, where you pay it separately, or is it rolled into your mortgage?
So it's included in your monthly mortgage payment, just like your taxes and insurance will be, because you will be escrowing with less than 20% down. So every month when you make your mortgage payment, you will be paying your PMI. And when you get your original loan estimate and all part of the application process, you'll know what that amount is, because it'll be included in any estimates provided to you.
Okay, perfect.
So VA is the only one that doesn't have a monthly PMI.
Okay, good to know.
Yes, it's great.
And then what about like a USDA loan?
USDA loan also has monthly mortgage insurance.
Okay, but that's an
they call it different things, but it's what it is. They call it a guarantee fee.
So like any loan product out there that's not a VA loan, for the most part, if you don't put 20% down, you will have to pay PMI based on the loan amount.
That's correct.
Oh, I'm so smart. Okay.
You are so smart.
So I know that, like, in the past with some of our clients, say they did have enough cash to put down for 20%, but they end up putting down 19% because if you put down a little less, your interest rate is lower. So explain.
Yeah, so basically, yeah, exactly. So basically, PMI adds a layer of security for the lender. Lenders love security. Anytime there's less risk, you are going to be rewarded in your interest rate. So sometimes it's shocking to see that your rate is better if you put less down because you have PMI versus if you did put 20% down, because there's no protection in there for the lender. And it seems grossly unfair to be penalized for putting more money down, but that's kind of just the way it goes. Everything's about layering of risk. And so when you have something like PMI that reduces risk for the lender, that usually benefits you in your interest rate.
Okay, awesome. So,
and go ahead.
Well, so I was going to say, so like if you have 20% to put down, but you can get a better interest rate, they'll put 19% down and then they just carry PMI for 2 years.
Yeah, that'll work in some situations, like you and I've done. It depends on the credit score. There's a lot of factors. Depends on what that loan amount is. What is that monthly cost going to be for the 2 years or so that you carry the PMI? That's part of what we'll do is a cost benefit to see, is it worth it? Is it worth it for you to have that PMI if you get a lower interest rate? And it depends on what market conditions are. Sometimes it doesn't make a difference in pricing, and in that case, it might not be worth it.
Okay. And is there like a minimum number of years that you have to carry it in order to get rid of it? Or what's the rule in like getting rid of your PMI? Because you don't have to carry it for the entire like 15 or 30 years of your loan, right?
That is correct. So let's say you're putting 15% down and it doesn't take you but 2 years to get to a 20% equity position. It's actually 22%, but we'll say 20%. You have to have PMI, depending on who is ultimately servicing the loan, for 2 to 3 years. They will season it. So let's say the market explodes 6 months after you buy your house, and now your property is worth enough that you are at an 80% equity position, or you have 20% equity in your property now. Technically, you would want to reach out to your servicer and get rid of your PMI, but you've only had your loan for a year. They're not going to let you drop it. So there is a seasoning requirement. You can't do it like right away. Okay. And every investor is different. So, if we've gone Fannie or Freddie, or we end up selling it to Wells, but usually the seasoning requirement is 2 to 3 years. And you have to have a perfect payment record. If you have one late payment, and by late, I mean over 30 days, they won't let you drop it.
Oh, wow. So
yeah.
So then you'd have to keep it forever until you refinance.
No. So it automatically goes away once you've paid your original loan balance down to 78% of the original purchase price. Okay. So for example, if you buy a $100,000 house and you put $10,000 down, and so now you are borrowing $90,000. Once you've paid that $90,000 loan down to $78,000, because that's 78% of $100,000, which was your purchase price, then it will automatically go away. You don't have to do anything. Okay. But the time that it takes you to get from 90 to 78 is often longer than it takes for your house to naturally appreciate to give you the equity position. So a lot of times it's quicker to have appraised equity versus wait for you to pay down your original loan balance to 78% of the purchase price.
So say you've had your house for 2 to 3 years, whatever the seasoning is, you have to get it appraised?
Yes. So, and you don't go out and just get an appraisal on your own. Okay. So what you would do is reach out to the servicer who you write your loan checks to every month and say, hey, I believe my house is now worth X amount of dollars, which means based on my loan balance, I have a 20% or more equity position, and I would like to have my PMI dropped. So then what they'll do is they will order an independent appraisal, and if the value's there, they'll just drop it. You don't have to refinance. I think there's a really nominal fee, maybe $100 or less, and boom, just that portion of your payment just disappears.
Okay, so
it's amazing.
You have to pay for the appraisal too?
You will have to pay for the appraisal.
Okay, and how much is an appraisal?
Appraisals run about $400 to $500.
Okay, so you're about $600, $700.
Mm-hmm.
Okay.
Yeah, but it's worth it. If you've got another 6 or 7 years to pay on your PMI for it to go away automatically, it's worth the money to get rid of, depending, your PMI on a $400,000 loan, it can be $300 a month, depending on your credit score. So it can be really expensive, PMI, if you're not putting very much down and your credit score is below 700, PMI can be very costly.
Okay. So in other words, like put the money away in preparation for buying your appraisal and paying that fee.
Exactly.
And
You know, people have a negative connotation about PMI. They think it's a bad thing because it doesn't benefit them. It benefits the lender. But indirectly, it does benefit the borrower because it makes programs available for less than 20% down. Without PMI, the majority of these programs would not be available to the average consumer. And most people don't have 20% down laying around in their bank. And so, you know, it feels like something like, well, I don't want to pay that. It just goes to the lender. Well, I mean, it really goes to you too, because you might not be able to get that house otherwise. Right. And, you know, depending on what your income is, and, you know, I'm not a CPA, so I can't give tax advice, but at least as recently as last year, 2017, you were able to deduct your private mortgage insurance if you were making less than $100,000 a year. So that was a tax deductible expense. So, you know, all the tax laws are changing in 2018, so we'll be curious to see where PMI falls into that, you know, if we'll still be able to deduct it. That I'm not 100% sure. That's a good question for your accountant.
Awesome. So, and then like PMI is only for your homestead, right? So that's why if you're buying investment.
No, you have you'll have PMI on a second home too if you're putting less than 20% down.
Oh, really? I thought that's like if you were buying an investment property, you were required to put 20 to 25% down because there wasn't PMI for it.
Yeah. So on an investment property, yes, but a second home, you don't have to put 20% down.
Okay, perfect.
So a second home, if you were putting 10% down or on a 15% down on a second home, you would still have PMI.
Okay. So a second home is just like, say I live in Austin, but I have a second home in Dallas, and I have to prove that that's my homestead, that I have two, right? One in Dallas.
Well, yeah, you would have to be purchasing it as a second home, not an investment property.
Okay.
Because then the down payment requirements change.
Okay. And if you lie, that's fraud.
Yeah, don't do that.
They find out everything.
Be surprised the things we can find out.
Like the IRS. Good luck. Good luck. So anything else you want to add that you think would be beneficial?
Well, you know, a lot of people who don't have 20% to put down, they look at an additional product called an 80-10-10. And that's where they get a first lien at 80%, a second lien at 10%, and then they still put 10% down. And a lot of people do that to avoid PMI. That is not always the wisest course to go. Again, it's a mental hang up on, you know, people are predisposed to look at PMI negatively. But when you do an 80-10-10 versus having a single lien with PMI, you're going to have a higher interest rate on your first lien and your second lien. And often it's going to take you longer to pay off the second lien than it would for you to drop your PMI because you have appraised equity. So it's, you know, just make sure that you get a comparison for both options so you can truly see, is PMI a bad thing? Because typically it's not. And that's the kind of the battle we face from the lender side, is that, you know, people say, I don't want PMI, I don't want PMI, even if it benefits you.
So in other words, work with a great lender who knows what they're doing.
Yes.
Who can explain everything to you.
Yes, who can show you the cost benefit for each option so that you can make the best choice for you and your family.
Awesome. Well, thanks so much, Shelbie. So we're going to be doing a series together of Ask a Lender. So if you have any questions, just leave them in the comments below. I'm also going to leave Shelbie's information because she is an amazing lender in Austin, but she works for Fairway Mortgage, and you're like the fourth largest lender in the country.
Nationally, we're in the one of the top 5 largest lenders in the country.
Awesome. And she can close a loan fast. She's amazing. So if you need Shelbie's information, we're going to put that in the comment section below too. So thanks so much, Shelbie. I'll see you.
Thank you. It's good to be here.
Bye. So thanks so much for watching. I hope you found this informative. If you did, please give me a big thumbs up. Subscribe to my channel or share this video with your family and friends. If you have any questions, you can leave them in the comments section below, or you can contact me directly through my website, austin-texashomesforsale.com. Thanks so much, and I'll see you next week. Bye.